ରଖିଛି ସଞ୍ଜୟକୁ ଦେଖାହେଲେ ତମ ହେଲମେଟ ଟା କିଏ ନେଇଯାଇଛି ଭିତରେ ରଖିଛି।
Very good afternoon, Gupta sir, for joining us again.
Hello.
Yes, good afternoon, sir.
Good afternoon.
Welcome back.
Thank you. Thank you. There was some problem in my system, I think.
Fine,
so sorry
sir,
for
fine,
joining a little late. But yeah, let's start with the class today. So we will be discussing today something on so hope everyone has gone through the code that I have sent you today yesterday. Today also I sent today's class code. I hope to Sachin sir. So that you can, but I hope you would have had a chance to look at what we discussed yesterday. So let me recap it for you. We discussed basically the different portfolio creation strategies, portfolio optimization strategy, and then we looked upon how a portfolio is created from the point of view of constraints, what type of constraints we use, what type of objective functions we apply. We didn't use the entire length and breadth of the functions that we use, but I gave you a brief of like what are the types that we can apply in case you are interested in the and in doing different even more complicated constraints like using more objective functions. I can guide you how to do that. But yeah, so that is one idea about it. We also saw the capital allocation line, the kappa model, and the Sharpe ratio, how we calculate. We calculated the efficient frontier. We saw how an efficient frontier is being used in financial analysis, and how the kappa model and the Sharpe ratio helps us in determining our optimum portfolio and trading strategy. In today's class, I will touch upon a slightly different angle of a trading strategy which we call it as algorithmic trading. And what do we mean by algorithmic trading? Along with time series analysis, it's mostly used in conjunction with time series analysis, and hence I would like to cover a few aspects about it. So with this thing in mind, so let's start today's class. In we will also be covering back testing today. That will be the last topic for this session. Um, in back testing, we will see what we do. So let's start today's today's session, right? Okay. I haven't opened RStudio. RStudio crashed, I guess. Let me open up RStudio.
Sure, sir.
Okay. Good. Actually, we'll start with the theory a bit, and then we'll cover to the next part of it. So let's. Okay. So algorithmic trading, what do we mean by that? It's very related to our portfolio optimization. We create uh, a trading strategy that works for us. See, at the end of the day, the only one and only goal of our investment strategies is to make profit, right? If we can't make profit with even with doing so much analysis and creating so much uh, mm, diverse concepts, it is of no use for us. The only reason we need to know about all this is to be in a position that we are, whatever investment decisions we are making with respect to the stock market, of course, and equities, uh, we should be spot on, and our chances of making loss is very minimal or null, right? So in the next, in this class, we are going to talk a bit about our algorithmic trading and describe some of the broad concepts that we need about algorithmic trading, and we will also show you implementation of an algorithm in one of the algorithmic trading strategy that we will use. It does build upon the things that we have learned so far in the class, and it will also touch upon the time series data, right? So I hope you will find the next set of this set of lecture also as more engrossing and useful for you in the long run, right? So let's with the thought, let's start. So what is the algorithmic trading? And so basically, it is a style that utilizes the ability of the system to process data quickly and react faster to changes in the market. How will you become more efficient is by becoming more faster than the market, right? So this approach is generally based on hard data rather than forecast or opinions. More than that, it is based on hard facts, hard data, right? So in the process, it quickly and it will help us in making our decision to buy or sell more efficient. So what are the objectives of algorithmic trading? The first is to maximize our profits, definitely. Next is to optimize our execution cost and reduce our market risk, right? In the portfolio theory section, we talked about the trade-offs between risk and return in the efficient frontier. When we were creating, we talked about the trade-off between risk and return, right? So don't always think that the algorithms that we are using are optimizing along. So it is just about profit, right? They might be also optimizing along other dimensions. So that is with that thought. Now, what are some of the major categories or broad categories of algorithmic trading? So there are few. One is called as the mean reversion. Another is the momentum strategy we have. Then we have something called as the statistical arbitrage and the trend following strategy. So we have four categories of in broad. We have four categories. Then there are multiple in betweens also. The mean reversion strategy, the momentum strategy, the statistical arbitrage strategy, and the trend following strategy. So let me talk about these a little bit in more detail, right? The mean reversion strategy is a strategy that exploits the tendency that many of the asset prices revert to some mean after a period of time. And it really tries to capitalize on these extreme changes and price of security, assuming that it will eventually bounce back to its mean. Means it will eventually bounce back to its mean. Right? So RSI, if you would have known, is one of the indicators for the mean revert strategy. It is one of the packages in R also. But yeah, we'll discuss a different algorithm. Now, coming to the momentum strategy, what is it? What does it mean? It is based on the presumption that the price of an instrument or an asset has some inertia. What do you mean by inertia? So let's say asset price is going in one direction. We expect it to remain the same in the short period of time. So momentum strategy is basically not a long-term period. It's a short-term time frame impact of an asset. You will see movement up and down, and you will try to capitalize on that movement in the stock price, right, based on the sentiment of the market. So this is about the momentum strategy. Now, what is a statistical arbitrage? Now, let's say we have the market. Basically, it involves a long and a short position of different securities. It generally, when the price of a stock is not based on its actual valuation, and it is dependent on some factor in the market. For example, let's take an example. An example is, let's say there are some external forces that suddenly shift away the prices. Let's say due to government policy, maybe weather. Let's say because of weather, a particular region is not getting some food supplies. What will happen to the food prices in the short run? It will move up. So there will be, because of multiple reasons, might be. Even if the government would not have increased the prices, because of hoardings and all, it will go up for that region, right? So that is about the statistical arbitrage. You will have to be aware of all these scenarios when you're making an investment decision, right? So you need to be aware of the market influence. Government policy example. Modi comes up with some a policy that helps a certain sector in certain way, all the associated services and products related to that sector will have a positive sentiment and will move up. The prices will move up. You expect that to move up. Right? A great example is merger and acquisition, right? When a company is going to be acquired by another company, what happens? The stock price of the acquired company is going to go up. So if you have the knowledge that the acquisition is going to happen on a certain day and you buy the price stocks, you're naturally going to make some profit out of it. One of the known principles in merger and an acquisition, right? The fourth strategy is what we will bring it into implementation also, is called the trend following strategy, right? Let's talk a little bit about the trend following strategy. That is the fourth strategy. And that is the one we are going to see in implementation and um, what that means. So the goal of this strategy is to buy an asset when the price goes up and sell it when the price trend goes down. So basically, these trading decisions are based on some technical analysis and market patterns or indicators, right? So we will use something called as simple moving averages to decide on what is a algorithmic trading strategy or for trend following strategy, basically. So let's see a trend following strategy in a little bit more detail. Let's just dive in a little bit, right? The trend following strategy, it works on the basis of historical price averages and price movement of these assets. We will be using something called as a simple moving average techniques, SMA, simple moving average technique. We are going to calculate it for 2 time periods, one let's say for 12 weeks and one let's say for 26 weeks, 2 simple moving averages. So what is a simple moving average method? Can anyone tell me? What is the SMA, simple moving average?
It is the average which goes on moving day after day or period after period by taking certain number of days as the base. Absolutely. It could be 5 days, 50 days, 200 days, and so on. Very good, very good. It can be not only days, but it can be any time period, like week. Any period, any period. Correct. Very good. So that is a simple moving average. It's the most basic form of time series that we know of. We have the advanced concepts like the exponential time series, exponential smoothing method. Then we have the Holt-Winters smoothing. Then we have the Arima method, which is the most popular actually of all the time series. Because we are not discussing time series in detail in this session, this session, and I will not cover the basics of the time series. And I will leave it up to you guys to get a further grip on any one of these topics if you know. But let's concentrate on the simple moving average method for this class and see how we can model a trend following strategy using a simple SMS, simple moving average method in R, right? So what we are going to do is we are going to create some sort of fast moving average, which is a short time period. Means any simple moving average for a short time period is basically a fast moving average, because in a short period we expect more. It's a fast moving. And we are also going to create a correspondingly longer term period also, which will reflect a long-term trend. Means one is a short-term trend we will see, one is a long-term trend. So basically 12 weeks and 26 weeks. This is what we are going to use. Now, there is one very important aspect of time series, of basically technical analysis. From the theory of technical analysis,
what it says is, if the fast moving average crosses the slow moving average from below, then there is a buy situation, right? And when it is vice versa, when basically the fast moving average crosses the slow moving average from above, that means it's a sell position. You would have seen that candlestick chart that goes on. We'll draw it and we'll come to that and how we will decide our trading strategy. Now let's say what happens is that there is another situation where we can't do anything. Means when the uh, trend is neither cutting the when the slow moving average is neither cutting the fast moving average from above or below, is basically a stagnant situation, right? So with this knowledge, let's go to our R session and actually see that in implementation, how we can go ahead and implement our scenario with this. So let me share my screen. Okay. So good. So let's start importing our libraries. The first thing that we do in our, as we know, is call our libraries. And the first and the foremost library that we call is our quant mode, right? Library. The next library that we will use is something called as next ROI. Then we have library called as performance analytics. Now we are using something on our time series. So we will use some of the time series libraries. One of the most important library in time series is called TTR. I already have installed this. Many of you will not have this library, so install this library in your through the install packages, as we have discussed. Same process. Another library that I will use is something called as tidyverse. These are again time series related libraries where when we work with time series data, we use these libraries a little bit more in advance. Now let's create our the stock that we will be using again from the Yahoo. Our Yahoo class is called as AAP, right? It's an auto part related company. I think it's Audi auto part, something like that. So that is about the class that we will be using. So let's use this AAP. We create our this called as that. We'll use get symbols. Yahoo. The stock price that we are talking about, the ticker that we are talking about is AAP. It's not AAPL, Apple, APA. What was Apple for? APPL, right? We are not using that. So let's, now let me not use this. I will show you another way in which we can use the, we can subset our data with respect to from a given time period. I will not use this ape. I will just use auto assign, auto loader, auto dot assign, dot assign equals to f, and I want to use another thing here, which is called as return dot class equals to xts. It will help me in returning the values in the form of, I think I will also have to use this library. Library xts. It's also a time series library. Again, it helps us in making our data in the form of time series. I only want my adjusted closing prices. Oh, just a second, guys. Somebody else. Sorry, guys. So let's start with get symbols dot Yahoo. This. So it's get symbols. I think here we have to get the source. Like this, because I'm using that. Is there some spelling mistake? Get symbols here. Something. Symbols. That's right. Function get symbols. Is this something that I did load? Oh, today I didn't run this. That is a main error when we will get when we don't load the packages and then we run this, right? You're thinking, what is it? Okay. So let it load. It's a pretty big data, that's why. Okay, it has started from 2003. Now I wanted to show you like how we can restrict it, our data in others from. So let's say we want the data only from a certain period. But before that, let's calculate our returns. So let's calculate our returns, which is like difference of log. So it will take the log of each day and just subtract the logarithm of one day with the previous day to get the returns. It's very simple, like the way we did previously. Now let's say column names, if we return is I want to column names AAP returns. I want to use the same column names as this. Basically, I'm passing the column names. Now let's trim our data set in the sense that I don't want to use a data prior to 2010. I want to use only after 2000. And what I can do here, I can just pass 2010 forward slash, and this will trim our data. Let's see how it basically trims. 3. So you get AP return, and then AP is something like AP 2000. So now let's see what does AAP has. Still it has 2000. Yeah. Now you can see it has from 2010 onwards, and you will not be able to see anything before 2010. So where you are restricting your data to be after 2010 is using these two functions, and you are calculating your returns using this. It's a simple return. So if you can see, it gives you the return for each day, daily return basically, and so that is calculating the returns, and then we are restricting the data. Now let's plot our returns, and we see. No, basically we are plotting the prices. Let's see the plotting the prices, how it has fared. Okay. So you can see the price movement. And there is quite a bit of up and down here. See, in 2020 it went very down, then again it started picking up, and in 2018 it had gone down, again it had started picking up. 2016 also it was quite high. It was during 2015. It's, I think, Auckland social places. Yeah, anyways, it's like very similar to an US economic market. Anyways, that's fine. Now we will create our simple moving average methods, right? So let's create our 26 days simple moving average method, and we don't have to do anything. We just have to use something called as SMA, and we will use AAP, 26. SMA, I think, is a part of your package for your TTR. So if you have invoked TTR, then it should work. And we will create a short moving average of 12 weeks. So we created a simple moving average from our AAP data for 12 weeks, and we created a simple moving average of our further 12 weeks data, 26 weeks data. They are independent columns, you see. There are a lot of nulls also, NAs also. So we'll have to omit the NAs also, right? So, and I want to bind them to our original data, which is to this data, AAP. We want to add it here. So what we can do for adding that here is something that we will see. Let's see. Let's create another variable called as data, and we have to use na.omit. Yeah, na.omit because we don't want any null values. And what we have to do is basically we have to create first as a data frame. We have to treat them both as a data frame. We have to make this as a data frame, and then we can use something called as our cbind function. Column binding. We cannot directly use column binding when it is like independent columns, right? Two different data sets. First, we have to make it as a data frame, and then we can bind the columns in it, right? So I want to bind all the columns. AP return, SMA 12 and SMA 26, right? And I also want to give the column names. Column names, data, and we can give it as AAP price. First thing is what? AAP price. The next is what? AAP return. AAP return. What is the next thing is SMA 12 and SMA 26. And the next thing is SMA 26. So we have given the column names and we have given the so our data is created. Now you see we have the AAP price, the AAP return, simple moving average of 12 weeks and simple moving average of 26 weeks. Now the next thing that I want to do is we want to create our trading strategy. So what is the trend following rule? What does the trend following strategy states? As in the theory that we discussed, right? The trend following strategy states that if the fast moving average cuts the slow moving average from below, it's a sell position. If the fast moving average cuts the slow moving average from above, it's a buy position, right? So let's create another column in our data. And how we can create another column in our data is just by giving this $sign, and we can create any column name, but the column name that we have is UD. What I want to create here is just create a Excel-like function, if else, and what do I want to see? Data $SMA 12 if is greater than data SMA 26, means my slow moving average is greater than my fast moving average. Let's code it as 1, else code it as 0, right? It's a sell position. So let's see if this gets created or not. Let's click on our data. So you see a new column got created, UV. Good. Now let's create our sell and buy position. Before that, what is we have to create our trading position. What is the trading position is the same what we have written in the statement above. It's the same. If else data dollar UD is equal to 1, then buy.
So there's spell error in if else.
Huh?
Spelling error in if else.
Spelling error. Oh, yeah, thanks. So this is a buy, else it is a sell. Next, what we will do is we will create our position. And what does our position say? Because data dollar we have not run this section. Data dollar trade is equals to y. And let's code it as 1. Else as 0. So basically, if our position is coded as means we have to buy, means the long position the slow moving average curve cuts the fast moving average curve from above, then we are putting it as a buy condition, else we are putting it as a 0 or sell condition. No. We will not code it as 0, we will have to code it as -1. I will come to that. Means selling, when we are selling it, means it is a short position, right? So our portfolio weight is generally reducing corresponding to our sell, whatever we are selling. Whatever we are buying, our portfolio weight is correspondingly increasing on that aspect. So our trading strategy, so that is why we are defining it 1 and -1, so that each unit of stock that we buy, we increase our position by 1. Each unit of stock that we sell, we decrease our position by 1 unit. 1 unit, definitely one star the price of the stock. I'm assuming that it is $1 or 1 rupee, whatever unit price. So what is our trend following strategies return is basically our trend following strategies return is data dollar AAP return star data dollar position. We have not done it. Now, if you see data, you can see your algorithm's return. What you're doing, you had your returns for your stock device, basically the log returns. Then you created your trading position of buying or buy or sell. Then you created your position. You coded it buy as 1 and sell as -1. And then what you did is you multiplied your returns with your position to get the algorithm's return. Clear so far? So now once you created your return algorithm returns position, now let's calculate our annualized return. We need to calculate our annualized return. Annualized return basically will be nothing but annualized return. Annualized return will be nothing but your basically mean of your data dollar algorithm. Now, what is your algorithmic return? It is basically a daily return of the stock of assets, right? In order to calculate the annualized return, you will have to use this formula called as, you have to multiply or take it to the power of 252. Your daily return to the power of 252 plus 1 to the power of 252 and then -1. This will be your annualized return. So annualized return of 9.3%, which is not bad, corresponding to your overall portfolio. Now let's plot our returns. So you see that your returns are also very, very spread out, right? You have some very low returns also at certain point of time and high also at many points of time. So this is basically your candlestick star chart. You can create it like this. Now let's calculate our standard deviation. Standard deviation basically is, what will be the standard deviation on what you will calculate? Basically on the algorithms, right? So let's calculate our standard deviation. What is the standard deviation? It's 0.0198. That is also pretty high. It's 1.9% is the standard deviation. So let's calculate our Sharpe ratio. Let's take a risk-free rate, as we have taken risk-free rate of what we can take is 2%. 2% is the risk-free rate generally we take. Now the Sharpe ratio. However, what will be the Sharpe ratio formula? Calculation. We'll calculate the annualized return. annualized return minus your risk-free rate by standard. So what is our SAP ratio? Calculated. Standard deviation is 0.01985. SAP ratio is 3.694. So that is our calculation of our Sharp ratio, right? So Sharp ratio of 3.64 is decent. It's not bad. It's a good value. It's not so bad value in this. Anything above 3 is a good Sharp ratio, is by a rule of thumb. Let's plot our graphs and see how the price of the data varies corresponding to our data dollar AAP price and type equals to 1 and kernel equals to red and then its lab equals to prices. Par new equals to true. Now plot dollar SMA 12. The same thing we can use here. Is Booker Plane. Six. Make it blue. So let's see if it works. Some problem. Our plot type is not one. It's not. Line. We want to plot type line. Now it has come. So this is your chart. You see, So what we have done is we have tried to plot the actual price of the auto company along with the simple moving average and the simple moving average 12 weeks line and 26 weeks line. Expand it. Let's see. So green was our 12 week and blue is our 26 weeks line. SMA 26 weeks line. Huh? So what does this mean basically is, now if you see, whenever, what we have said, whenever the green, the fast moving average cuts the slow moving average from above, it's a sell position. Now if you see, the fast moving average is your green one because it is 12 weeks, and your blue one is your slow moving average. So whenever it comes from above, that will be the sell position. If you see specifically where around 1000 that value is, when the price is around 1000, it was a sell position that time. When it was around 1500, again it was a sell position. The blue is cutting from the top, the green line. Majority were sell positions. Now it makes sense also, right? If you will see the green line, when it cuts the blue line from top, the price of the stock is actually going down. See? So our trend following strategy is basically giving us a decent idea of when to buy and when to sell. Right? So this is one of the technical analysis methods that we use in deciding when to create a buy and a selling strategy for an individual. So we can very well extend it to a portfolio also, which will be a bit more complicated coding for that. But it will be the idea will be the similar one. It won't be a lot very different altogether an idea in terms of the implementation or the the overall theory behind the algorithmic trading, right? Now let's discuss the next topic that we have for today, which is called as backtesting. And let's see the concept behind backtesting. When do we use it, right? We need to know when do we use our backtesting fundamental. So let's open that. Okay, good. So fundamental behind backtesting. Any idea about what is backtesting? Have you heard of what is backtesting?
By checking, maybe, I mean, based on my common sense, checking whether what we found out is right or wrong. What we predicted, what we forecasted.
To a certain extent, yes. But the overall concept is slightly different. Let's
yes.
Let me explain it. Basically, backtesting is about using the values from multiple time periods in the past to test our theory, or any trading or any portfolio that we will create will definitely have some kind of bias or some kind of chances of error still, because we are using the same time period in all our calculations. Backtesting, what basically backtesting suggests to us is any strategy that we create, we have to test it across different time periods. For example, just the example that we took uh, in the previous example that we used only two simple moving averages, which is one for 12 weeks, one for 16 weeks, or one for 26 weeks, sorry. Now, and we use the time period 2010 onwards. We didn't say that, and we gave equal importance to all the time periods from 2010, 11, 12, 13, each time period had the same equal importance. What would have happened if we had taken only from 2017 instead of from 2010? So that is what backtesting tries to answer. Now so what is backtesting and how do we use it to evaluate the performance of an algorithm?
हमने बोला वैसे चश्मा शायद नंबर चेंज हुआ है, चश्मा आँख जल रही है, दिख नहीं रहा बराबर से।
Any point? Any concerns, guys?
Sir, sorry, sir.
Oh, no problem. Yeah. So we were discussing about backtesting. Yeah. So backtesting is probably the most key component of developing an effective trading strategy, and not just algorithms. Right? You can develop this manually as well, not necessary to create a function program for it. Basically, you use historical data and you execute your strategy as if you were doing it in real time. It allows you to determine if you're making the money or not making money, basically. So that is about more into it. Basically, so what it helps you is it helps you in fine-tuning your parameters that you have decided in your algorithm, right? So what I did is I generally pick the number of days for my algorithms, and I did it arbitrarily. Means nobody asked me to take a 12-week moving average. Why can I not take a 15-week moving average? Why cannot not use a time period from 2005? Why from 2010? Why from 2012? It was my gut feeling that I would go ahead with a time period of 2010 plus, right? But who says that that is the right number to take? That is where backtesting comes into picture, right? You would want to try for different days, not only different days, but different combination of your algorithms, right? You can also try different combinations of your days, of your stock type. You may take another stock from the portfolio. That is where you're actually you're making your portfolio much better, much more enhanced, right? In our case, we used a simple moving average, and we used and we use this as to also to backtest, right? Okay, so that is about backtesting. Now let me show you a small Excel meaning of backtesting. I think I have the diagram of that backtesting influence. We try to search it. Again, let me show you by drawing it itself. That would be the best way. So what I meant is, you have one portfolio in fifth time period. What you will do is in fourth time period. Fourth time period. And first time period. So let's say you have this kind of a portfolio. You use different parameters each time, whether it respect to your constraints, whether it respect to your objective, whether it respect to your return parameters in case of trading, or in case of your algorithmic trading, different simple moving averages, probably different. If it is only simple average, so you can use different simple averages. Maybe you can use ARIMA for one of them. You can use a different strategy for each one of these optimization period. What is these called is basically optimization periods. These are all your optimization periods, right? Nothing but your optimization period. Each period is your optimization period. So that is about your simple moving average. It's about your back testing. Now, with our knowledge, with this theory in back testing, let's try to implement a bit of this. in one of the programs that we will use. So let's use this. Sorry. Let's go back to our art studio. Again, the first step always is to import your libraries. Right. So library count mode is the first. Library performance analytics, and then we use portfolio analytics. That's okay. So we get our different portfolio analytics. We use this. So another library, we don't need to use the other libraries for now, but let me use it in case. Right. ROI. So let us now create our tickers as we created previously. Our tickers this time I want to create same tickers. Facebook, Amazon, Apple, AAPL, AAPL, Amazon, Amazon. Then we have Netflix. You have Google. Then we can use SQ. And NVDA. NVDA. Okay. Perfect. So I will run it. Tickers got created. Now our usual method of binding our tickers in this is a standard method that we always use of binding our tickers, right? Before that, we have to make our portfolio prices as null. Price as null. So portfolio prices are null. Maybe make it as portfolio prices as null. Now let's call our tickers. Start binding our tickers to our portfolio prices. Portfolio prices. Bind. Here, if you would see, we are not using anything like as.data frame, which we used in our previous. Remember why? We had different number of columns. And it will be difficult for R to understand whether we want to bind column or we want to create a different column altogether. So these are small. Once you start coding, perhaps if then you would be able to gauge that part. So, but don't worry about it right now. So get symbols.yahoo. Get symbols.yahoo. What we are getting ticker. Let's say from equals to which date we will be interested from 2016. Let's say 2016 01, let's say 03. Right. Periodicity we will have to give equals to daily. And we have to give our auto data site equals to false. Now, that's for ticker indicators, portfolio prices, CY and portfolio prices. Get symbols dot Yahoo ticker from 2016 periodicity daily. Order sign equals to false. I don't need to use the XTS object here, right? I guess I don't need to really use the XTS object here. Because if I use the XTS object here, return dot class equals to XTS. Use the library. This also. Let me run this. Okay.
What is this library XTS is doing here?
Basically, it is converting it to the time series data in the form of time series. Basically, means otherwise you will have. It's not important to keep it because we are not using. Because it is each day's data, but in case like you are doing some analysis where you're creating a graph or something like that based on some advanced form of graph and all, which is a time series graph completely, then these classes will be very important. This is not necessary to use it here. I'm saying, but just for it is converting our time data in properly in time series format. Like it will have the option of having the time, date, uh, the hour, the minute, the second, everything it will have the option. But we are not using it right now because we are not creating advanced time series graphs right now, right? Now you see. So your it's only one it got created. Where are my others? Ticker in tickers. CY and portfolio process with some. So, only NVIDIA has a proper date format. Let me see this. The time period is correct in everything. What is force? Because I gave these 7. Plus 9 equals to 4. What is the mistake? Amazon, Netflix, Google, NVIDIA. Because portfolio prices, buying. Oh, because I have done it correctly. Because is a one ticker only NVIDIA is given. What mistake is being done? Portfolio prices. Yes. So, one of combined. Anyways, let me do a little bit of use the code mark that I've already written. So clear this out. It is again. Define the tickers. Ticker and tickers. Okay. Now we are getting all. I think there was some small mistake in the code which we were not able to find. Anyways, good. So we got all the closing prices of all our 6 stocks in this window. Now let's go ahead and create our portfolio returns, right? The next step is always about portfolio returns. Portfolio returns are something. So we want to omit our null values and we will use the ROC function to create our portfolio return. We use many different type of functions to create our portfolio returns, right? In the previous example, we have used something called as the log return. If you would remember, the function that we had used in our previous function to create, find out our returns was diff log returns. In this function, we are using ROC as the function, which is an inbuilt R library to create our R function. Let's run this. So you have your portfolio returns for each one of your portfolio. Now let's go ahead and create our constraints, right? The next step that we have is create our portfolio specification and create our constraints. So portfolio specification, which we'll call as portf. So the first, we have to give our portfolio specification. Portfolio returns. Portfolio dot specification. Now we will add our different, what do we add? Our different constraints, right? So what are our constraints? Add dot constraint. The first constraint that we want to add is what? On the weights, right? Type equals to weight underscore sum means we want to put a specification around our weight underscore sum. And what is the value that we want to take? Min underscore sum is equals to, let's use something different. Max underscore sum is to 1.01. Now, if you see, what does this mean? Can anyone tell from our previous, from yesterday's discussion, what does this sentence will mean? What will be the meaning of this sentence?
Put in the constraint, the sum of all the port will be equal to not more than 1.
What will be the maximum weight of my portfolio in this case?
0.9, sorry, 1. It's
But
1.01, but it is less than 1.01, so almost equal to 1.
Yeah, no, it will be actually means it can go up to 1.01. How will it go up to 1.01? Means you have sorry, more long positions in your stock than short positions. Getting it?
So are we putting a short positions also? Because I think we'll at some point we are taking that the weight is all stock has to be plus more than 0, no?
No, not necessary. Weight can also be negative.
Okay.
Weight is negative when we have the short position.
But then your minimum sum is equal to 0.99. You're saying that the weight is positive. That means.
Yeah, yeah. That is. This is a summation, and it is not an individual.
Okay.
All the stocks together.
Okay.
Minimum, it cannot go beyond less than 0.99 and it cannot go above 1.01.
Okay.
Which is 100 on, yeah, it is actually 100%. Means it's just 101% we are saying, 1% buffer.
Yeah, okay. So that means we're taking short portfolios also, short stocks.
By default, any whenever you're creating a portfolio, it will, we are not taking it. The algorithm will always consider that you may have a short position.
Okay.
This like it's not a manual creation, right? All the different, as soon as you state this constraint, how many permutation combination is possible out of the 6 stocks that you have? All the combinations will be brought into picture when it will start executing this formula.
No, but yesterday I think we discussed some box constraint. That means we can impose
There are
a section.
hundreds of constraints actually which we can apply.
Yeah.
Box constraint is something that where we are stating that it is not going beyond. Again, that is also similar. Means like we are saying that the minimum way sum of the portfolio will not go beyond this. Maximum will not go beyond that. But a slightly different nomenclature of using it. Slightly different way of stating that. We also have group constraints as we saw. But then there are many multiple other constraints, like we have position constraint, we have diversification constraints, we have turnover constraints. So many constraints, you can add hundreds of constraints actually. All for devising your trading strategies. It's only that the choice of your constraint remains with the person who is devising the strategy. But we are not truly getting into the point of what is the right thing and what is the wrong thing. We are into the point of how to do that. This time we are adding another constraint called as transaction cost. We have added a constraint on the transaction cost this time. We will also add a box constraint. So the box constraint is basically on the individual stocks, mostly the values. When you do a weight sum, this constraint is on the summation of all your stocks. Let's add a box constraint also. We can directly see what is the difference between somebody since said box. We will directly see the difference between the first and the third line. Okay, what is the difference between line 20 and 22? Constraint. How is line 20, this line, different than this line? Okay. So what this line is basically meaning is you have 6 stocks, Facebook, actually 7 stocks, 1, 2, 3, 4, 5, 6, 7. What the line 22 states is that the weight of Facebook cannot go less than 0.1. Apple cannot go less than 0.1. Amazon cannot go less than 0.1. Similarly, the others. Also, it says that Facebook weight cannot go more than 0.4. Apple weight cannot go more than 0.4. Amazon weight cannot go more than 0.4. Similarly, the others.
So which means it takes out the position of short position now. That means now there will be no short position.
Yeah, there is no short position, correct. In this, there is no short position. So automatically what will happen is it will never become 1.01. it will always be less than equal to 1. So one constraint will nullify the other. In this, what it means is that it can be 0.9. All the summation of these weights should be 0.99, or minimum should be 0.99. It can also go to 1.01, but given that we don't have any negative shorts, as you said, we may not go beyond 1 for this specific scenario. So by adding the box constraint, you are actually saying that, yeah, you may not reach a negative or a short condition. Okay, good. Let's add 1 or 2 objectives also. Add objective. So objective. By this line, what we are basically meaning is that our standard deviation cannot be more than 0.005 of my portfolios. Now let's limit our portfolio. Means if you just run it with this permutation combination, like it can be so many portfolios that can be created, right? So let's limit it to 1,000. Means as soon as the counter.
So our objective is what? We are just saying that risk is SD is 0.005 and maximize return. That's what I'm saying it.
Our objective always remains to maximize our returns based on a given risk.
Yeah.
But
so we compute the Sharpe ratio of the portfolio, then we can do it and maximize that part.
Yes, what we want to say is that our mean cannot be less than plus minus 5% of our returns, of our best return. And given that our standard deviation is not less than 0.005, at a standard deviation of less than or equal to 0.005, sorry guys, at a standard deviation of less than or equal to 0.005, what is the best return that I can get? That is what this thing will, when you run this program, that is what is the expectation of this. That is what
exactly it is that. That means we are targeting SD. That means
exactly.
So, but in the reality, if I say I can increase the SD provided the return is increasing, so that means can't we?
Then you set your SD according to your risk profile. I have set it because I say I'm saying I can take only this much risk.
I'm saying risk adjusted return. Why can't we take the risk adjusted return as the target variable?
You need not do that. You can remove that. This is an optional parameter. So you can let the program decide what is the best return for that it can give you based on a given standard deviation.
Okay.
As your efficient frontier, you used to. same as the concept goes same as the efficient frontier.
Okay.
Because it is optional. I may very well say that there are two types of profile, right? Some people will say, give me the maximum return for a reasonable standard deviation, and that reasonable standard deviation is a more of a qualitative value or more of a not a decided value. It's like your efficient frontier is going flat, maybe at quite a extended standard deviation value. So many times people limit it, saying that yes, we don't want to go beyond a certain standard deviation given situations. But that is again different dream where you're deciding what is the best possible for you. But we are not into that level of discussion now. Let's create our portfolio. Given this is what we think is the most optimized thing for me or for us, right? Let's do that. So we will use this function called as optimize.portfolio dot rebalancing, yeah. Optimize.portfolio dot rebalancing. Portfolio dot returns. Okay, portfolio returns. Portfolio returns. So basically, what we want to do is we want to create different combinations as the portfolios, the random portfolios we have created. Now we want to rebalance now. What it will do is this method, it will take different time periods in the past, and it will let's see how we basically giving the returns we are taking based on different time periods. So if you would remember our idea behind backtesting was to use basically different time periods in the past for all my portfolios. So I want to randomize my portfolio selection across different time periods in the past. It will be in the same what we have given within the same time zone or time period, like from 2016 only. But it will not, all the portfolios will not have from the same time period from 2016 till now. It will be slightly different, and the program will randomize it to get the values. So rebalance on, I can say rebalance underscore on. What will it do? And let's say we give months, right? What is this? We will give months, right? And we'll give training period as 1. Let's see. And rolling window as 10. So 10 months rolling window should be fine. Now, what I am doing here, I am randomizing my selection of time period for my portfolios. And each time it does, it will rebalance. And generally what I am taking, I want the rolling window to be 10. So like minimum 10 weeks difference between one with the other. Between one time period with the other time period. That is what we want. And the duration, it will select based on the number of months that it will have. So let's run it and see if our backtesting algorithm is working perfectly or not. Portfolio.spec, we didn't run it, right? Error. No comma. Portfolio spec created or I didn't. Let's run this. And there is an error. What if? What the hell did I do here? Control L. Still got created. So randomized portfolio it created. Now I'm rebalancing it for once a week. Rolling window equals to So it will also give you some idea about your consider relaxing minimum 0.99. Optimum rebalancing. So it has given you an approximate weight for your portfolios, but actually some are going negative also. That's fine. No parallel backend registered. Then it's fine. Leverage constraint means some else. Okay, the constraint we can review it later. So I was just telling the methods, but hence we can discuss this constraints. We will always have a little bit of a constraint on that. Now, hence, for the brevity of time, let's create our benchmark portfolio. I'll create it here. So we create the benchmark portfolio in order to measure the performance of our portfolio against the benchmark. So there is something called as we have created equal weight based on our portfolio returns and our portfolio depending upon our portfolio returns, right? So for our benchmark, we'll use an equal weighted portfolio by default. And we will use one of the libraries in Yahoo, which is called as Pi. This is basically gives the equal weighted. I'm using whatever I have written in the past for exiting because of we will be running short of the time in if we go line by line in that way, but we can always analyze, come back. So what we have done it here is we have taken this library called as Pi from Yahoo's library, which helps me in getting the benchmark returns. If you will see, if I go here, these are our portfolio benchmark. Against this benchmark is what we consider the model that we have created. We always benchmark it against our given or we always consider the performance against the benchmark portfolio. So benchmark is something that.
So is this benchmark portfolio comprising the same stocks which you have taken, or they're different stocks?
No, it takes the average of all the stocks that we have considered basically. So there is a specific library in in Yahoo, which has the historical risk-free rate of returns of whatever stock that we will mention.
For example, in this, I think you have taken S&P 500.
Yeah, correct. So this is the average return, so the benchmark return uh, of all the stocks in the market. So SPY is what we use. Let's see what this actually S&P 500 prices looks like. So basically, it is like you can say this is a market valuation, right? So you have your individual price of your stocks, and you have created a portfolio based on that, and you have the market performance based on each day. So your benchmark returns are basically your market returns. Now, if you will see here, what we are saying is we are creating a equal weighted. Let's see what the equal weight gives us, right? So by default, it will be 0.143 here because there are seven stocks. 7 divided by 100 is 0.143. Yeah, correct. 14.3% basically. So 7 divided by 100 is 14.3%. That makes it 0.143. Now each one of these equal weighted stocks, how much that overall that has a contribution in your S&P prices. Yeah. So let's see if I don't keep this, what will be our S&P prices? What will we get? The market return. So basically, this is your opening and closing for your entire. You call it SPY, or sometimes you also call it BSPY. Star. On this. It's not BSP, it is called BSP. It's called something else. So anyways, this is SPY, and this is so basically that is nothing but your index prices, your benchmark prices. Anyways, let's finish this. Now let's very important thing. We need to extract our weights, right, from optimum rebalance. So optimum rebalancing was our main thing where we created our balanced portfolio of multiple return. Now let's see what is our balanced portfolio looks like. Large optimize. Print. Well, You're seeing it, it has taken different time periods, basically mostly the month and time periods, and it has assigned different weights. In each time period, it has taken a different weight each time. And each time period, it has said that a different weight is going to be more efficient for that time period. So we are saying that, so we are seeing that our weights will have to be adjusted in for different time periods in the past in order to get a more efficient formulation of our balanced portfolio. That is what we call as balanced portfolio. Now let's print our balanced portfolio over time. Basically, we need to SPY is needed for now. It's very interesting. So for each time period, if you see the proportion of different weights, now you can, this shows in color format. For example, in 2016, let's take this. The weight of your Apple stock was much lesser, but going in 2016 second half all the way till I think 2017 first half or the first 6 months, the weights of your Apple stock has been taken more. For Amazon, you see, starting off till first half of, or till all the way till 2017, all the way till 2017, maybe first half or first 6 months, it was less. Then it went up. In between, there was some down, and then it had more weights. That is what it says. Yeah, Google stocks have been most consistent. They're saying that it's one of the least impacted stocks, but it's you see its weights are also almost constant. It's not much changing. Nvidia is same actually. So Apple has shown a more ups and downs. Netflix has shown a lot of the Netflix after 2020. It has become so. They're asking us to keep a lot of increase the weight of the Netflix, if you will see, compared to what it was before 2020. Signs of lockdown is maybe. Anyways, so that is what our portfolio rebalancing strategy looks like. Now let's important thing. Let's bind our portfolio and benchmark and S&P returns, SP 500 returns, and see how the values look like. Error in CBind. Rebalancing returns not. Okay, reval returns is I haven't run it. So we have to run our portfolio returns also, right? Optimum rebalancing. So we have something called as our portfolio returns, which is basically our this one. When we did not apply anything, any constraints, it is just our portfolio return. That is what will be your rebalancing returns. Rebalancing returns will be something, yeah, that's only without rebalancing, right? No, okay. Optimum rebalancing is what we have given the portfolio returns. That's fine. Let's run it. We didn't run it. Okay, good. All right. A lot of NAs. Let me omit it. Can omit this. Okay, good. Now our portfolio return is 3, benchmark return is 0.04 minus 0.36. S&P close is -1 negative. We have minus 0.026. Our portfolio benchmark portfolio return is minus 0.02. Here it is 0.009. It is 0.013, 0.0056. It is negative in this. Yeah. So you are seeing that how your portfolio's return has fared compared to the benchmark portfolio, which is the average portfolio that we have.
In this case, the comparison is only between the weights because the stocks are same.
This is not a comparison of weights. This is a comparison of returns. Weights, we saw what is based on our the constraints and the objectives that we had applied. What were the best combination of weights that were spread across different time periods? We saw that, right?
Yeah.
This is about how our portfolio, based on the given conditions that we have given, is performing against the benchmark, which is how the means every time a fund manager will always compare the returns of his portfolio against the index of the market, right?
So in this case, this is not an index, no? That's what I'm talking about. This is not an index.
Yeah, it is index. It is index.
No, the benchmark portfolio is not an index. It's comprising only 7 stocks which are there in the portfolio.
See what it is doing is, if
index is S&P Series 500.
How it is doing, I will just show you. Just a second. Okay. Here we are calculating the benchmarks. What we are doing is equal. We are taking the equal weight as from the stocks that we are having. This equal weight is what we are passing on to our benchmark. So we are saying that means it is possible that the volumes will be much higher for in our overall in the Sensex, right, or in our index. We want to create a even. Hence, it is based on the weights that we have, but for the market, applied across the market. Clear?
Yeah. Okay.
Anyways, that's fine. Let's do something here. What is our average? Well, anyways, that analysis we can do it later. We can also see what is the average, and then we can do the same thing on the standard deviation part. So what is one we can do is,
So can we check buy and hold returns, sir, for a given time?
Performance summary we can check. That will have most of the things. So okay. We have mentioned. So your portfolio has been faring bad against the benchmark. So you will have to adjust your constraints and your objectives, rethink on them to reach up to the benchmark portfolio. What is the standard deviation of the drawdowns are lesser, but Your returns, you're seeing that the average of the portfolio returns of your benchmark portfolio has been higher than your portfolio returns for a significant period of time. Yeah, means it has matched up most of the period of time, but yes, there is more work to do with your model. That is what it suggests. Hmm. Dot closing, this is fine. This is then it is giving you the closing prices. Drawdown. This is where it says that the other during the negative periods, your stock has performed a little better. So in that way, the you have been able to what your portfolio is suggesting is that your returns have been a little lesser than the market for quite some time, um, but you have been able to meet reduce the market volatility, or it means you have been less impacted by the market volatility at the time when the market had gone down a bit. You will see this is the period from 2019 to 2020, somewhere around that. I'm surprised to see 19 to 20 was a lag for this the stocks that we have selected, or even for the market as whole. Mm, and you had taken lesser deviations from your market compared to your whatever the values that were there. Uh, Anyways, there is you can go on analyzing more and more. Try giving different weight combinations. I have already sent the code, so try with different permutation and combinations and check what is the best portfolio that you can make out of this. Just you have to change these constraints, these parameters, and you can use this model for creating the best portfolio that is as per your requirement. Hope that helps. And with this, we have come to the end of our sessions and courses. I hope you guys gained something out of it and will extend your knowledge.
Excuse me, sir.
I'm saying I hope you gained something out of it, the course.
Yeah, sure, sir. Sir, can you take a little time and explain how to calculate buy and hold return in it during that period of time?
Which return?
Buy and hold, sir.
Buy and hold.
Yes, sir.
Okay. The short position and the long position. Huh?
Yes, sir.
Okay. Let's say 2000. Let's take an Excel. Let's say 2010 Jan. Stock price was say 1000. 2010 Feb. The stock price become 1200. 2010 March, the stock prices become 1400. Short position and it becomes more intraday kind of thing. So if it is like months, I won't think that that will be a good example. Let's take within a day. Let's take it as what date today? 26/02/2021. 9 a.m. 10 a.m. 11 a.m. 12 p.m. Then 1 p.m. Then you have 2 p.m. Then we have 3 p.m. then we have 4 p.m. Then we have 5 p.m. Let's say here, your prices are going from say 1,000 to 2,000. There's not 2,000 that much, it won't increase. Let's say it will go up to 1,010. It became 1,020. So it is increasing. So you are holding on, right? This is what is the period is called as your long position. You are not buying, you're not selling. You will not sell because it's an upward trend. Suddenly in between, say at 11:10 a.m., what you saw, this became 1,018. But still, this value is more than your lowest value for the day, which is still till 11:10 it was 1,000. Now it can, suppose you buy it here, you buy here. You are given this recommendation of buy at a certain price, so you buy the stock at 1,000. Or from your technical analysis, you know that this is a buy condition based on your previous day's data. So you will put a stop loss 1,018. Will you sell it at 1,018? This is still not a short position. The reason it is not a short position is because this value is still much higher than this. So you will put a stop loss, right? What you will do is you will put a stop loss. What is the stop loss? Stop loss, you will put it at, say, if you have bought it at 1,000, then you will put the stop loss as 1,010. Means you will still hold on to this stock even at 1,018. You're not selling it. Let's say at 12 p.m. it became 1,012. Will you sell it? No, you won't sell it because it is still a short position. You're still making a profit, given that this stock may come up again. Because you may not, if it remains throughout that day 1,012, you will just let it be there. If this be 1,012, it is for the entire day, then you will hold on to the stock for the entire day and wait for the next day for the stock to come up again. Because that has been the trend you have seen. Now, let's say this becomes 1,010 at 1 p.m. Then this becomes a short position. So you will sell it. You will sell the stock here when it becomes 1,010. So you have to decide the stop loss criteria. You could have decided the stop loss criteria at 1,012 also. At that time, your short position would have arrived here. So you will define the code. What is the stop loss position here? Now, when you're designing a portfolio, say suppose your portfolio at 9 a.m. This is one of your stocks, and that there might be 30-40 position of stocks with your more. What happens of your stock at this position at 9 a.m.? Everything is 100%, right? Let's say that you have not sold anything else. Everything is 100%. You just bought the new share. Let's say you have 5%, then some 10%, some 15%. So everything combined together, you have 100% of your stocks invested. What happens at 1 p.m.? You sell off 5% of your stocks. It becomes 95%. Means what this means is you still have 5% of your money in your kitty to buy any other thing, which you have not done it, right? 5% of your money is at the back of you. It's still left with you once you sell this. So you get, maybe you get more. What happens is this 5% may be actually 6%. Because whatever the value of your stock was at the starting of the day, now given that this was, you bought it at 1,000 and now it is at 1,010, you have an additional 1% benefit. So 6% is left with you still, right? And then what will you do is you may invest it back into the stock. So your 100%, whatever. So if you decide that starting of the day, your entire value is 100%, it may actually go above 100%, given that you decide to buy back. Hope some part of it I would have been able to make clear.
Yeah, sure, sir.
We can discuss more. It's a
Sure,
very vast
Sure,
topic
sir.
to decide the long and the short positions. There are multiple criteria actually involved. Let's decide sometime.
Yes, sir. I have your mail ID also, sir. I can contact you.
Yeah.
Thank you, sir.
So we have come to the end of the session, and all the best to you guys.
Thank you so much, sir, for such an enlightening session. And, right from the trend following strategy you taught us, and also you taught us, back testing, defining the optimal portfolio. So thank you so much. And on this note, I would like to invite one of the participant, and Dr. Chaya Bagrecha. She is a professor of finance in Service Business School, Bangalore. So, Chaya ma'am, once again, good evening. So,
your voice is breaking, ma'am.
Okay, is it? Yeah.
I couldn't hear your last sentence.
Okay. I was saying that I would like to invite Dr. Chaya Bagrecha ma'am. She is one of excellent participant from the past 5 years. So I would like to, yes, definitely. So Chaya, I would request Chaya to summarize the entire 3-day session.
I can't hear anything.
Yes.
Hello, sir. Am I audible?
Yeah,
sir,
yeah.
Am I audible?
You are audible.
Yeah. Good evening, sir, and good evening, everyone. Good evening, Deepti ma'am. It's my privilege to propose the vote of thanks for this session and for these 3 days. Really engrossing and intense sessions on application of R in various portfolio management and investment strategies. What I can say is, sir has with his, sir, can I ask you one question before I say something? So
Sure,
how
ma'am.
many years into this work, sir?
Ma'am, I have been in the finance industry for the last 8 years.
And how many days how many hours per day you work? So definitely it is more than 10,000 hours of work, which is reflecting in 6 hours of his session. That is the ease with which he has taught us so many topics, starting from portfolio creation, then how to use objectives and constraint functions using R, benchmarking. Then today he spoke about algorithmic trading and many, many more. So what you have done is you have brought the horse to the water. एंड आपने प्यासे को समुद्र दिखा दिया है सर. अभी प्यासा उसमें से कितना पानी ले सकता है, that is up to the kind of thirst that the participant has and the learning interest that he has. But it was definitely, I mean, when I speak about myself as a participant, yes, few things were very difficult, few things were easy, and that too with basic knowledge of R I'm speaking, sir. But one good thing is with the codes that we have, if we practice and check your recordings, it will definitely help us in, achieving our objective of maybe teaching better or maximizing our personal wealth through investment. And one more good thing is, sir is from Bangalore, so definitely we will catch up later, sir, and we will invite you to our institution also. Thank you very much. And thank you, Deepti ma'am.
Thank you so much.
And thank you, Sachin. Thank you, Sachin, sir, for organizing such a wonderful session with so much of intense learning. That is from my side. I sign off.
Thank you so much, Chaya ma'am, and thank you so much, Chatterjee sir, for wonderful learning we got from past 3 days. So thank you so much once again on behalf of entire IBMR IPS Academy. Thank you so much. Sachin sir, you would like to speak?
Thank you, Dipti ma'am. First, I would like to express my gratitude to Pranvesh ji. Pranvesh ji, thank you very much. Being an industry expert, I know that you are busy and you have a very busy schedule. But despite of your busy schedule, you have accepted our invitation, and you have explained all that portfolio management concept using our software. And on our request, even you have sent all the R commands in Word file, and I hope participants are really benefited from these sessions. I know that these some of the commands, as Chaya ma'am explained, that some of commands are really easy, but some of commands and some of process are really tough. But the workshop job is to provide this facility, and later on it is depend on your practice. So for that purpose, again, we are uploading all these sessions on our YouTube channel. So in future, for the practice purpose, if you have any doubt, you can refer all these videos in future also. So Pranvesh ji, once again, thank you very much for sharing your time, sharing your knowledge, and explaining all that concepts to all the participants. On behalf of AICT, on behalf of all the participants and IBMR IPS Academy, once again, thank you very much. Hand over to...
Yes, sir. Thank you, Sachin sir. And as far as tomorrow's session is concerned, so tomorrow tomorrow will be the last day of this training program. And tomorrow at 10 a.m. we'll be joining back. And at 10 a.m. we'll be having resource person, Dr. Vinay Goyal. And Dr. Vinay Goyal is the associate professor of SPJN Institute of Management and Research, Mumbai, and he's going to share his insight on how to write good quality journals and what are the parameters. One should follow to get our research papers published in good journals. So, and that Vinay sir's session is followed by valedictory ceremony and assessment test. So first 2 sessions from 10:15 a.m. till 1:30 p.m. We'll be having session of Dr. Vinay Goyal, followed by the valedictory ceremony and the assessment test. So time, I am again reminding, we'll be joining together tomorrow at 10:15 a.m. And of course, the link for this session 3, is already floated in your WhatsApp group as well as in the chat box here. So kindly fill that feedback link as well. Thank you so much, dear participants. Thank you so much, Chaya ma'am. And see you all tomorrow in the morning at 10:15.